You know that feeling, right? You get a job offer, you see that big, shiny salary number, and you start planning your life around it. Then that first salary credit hits your bank account, and you're just staring at your phone thinking, wait, is that it? If that's you, don't worry, you're in good company. So let's crack this code and figure out where your money is really going.
Yep, this is probably the number one question that gets asked, especially in the first couple of months at a new job. That huge cost to company, or CTC, that looked so good on paper, it suddenly feels like a bit of a myth when you see what you actually get to take home. And that's really the heart of the matter. It's this frustrating gap between the promise and the reality, between what the company says they're paying you and what you can actually spend. And look, it's not a mistake, it's how the system is designed. But here's the good news. Once you understand the design, you can start making it work for you.
That is the million-rupee question, isn't it? Well, today we're going to answer it. We're going to break down your salary piece by piece so you not only get it, but you also learn how you can legally and smartly maximize every single rupee you take home. All right, let's dive right in and tackle the main culprit behind all this confusion, the CTC number itself. Think of it as the total bill the company pays for having you on board for a year. The catch? A lot of that bill isn't paid to you in cash every month.
Wow, okay. That's a pretty blunt statement from chartered accountant Abhishek Walia, but it really hits home, doesn't it? It perfectly captures that feeling of being misled. Because at the end of the day, your CTC is the company's math. It's their calculation of their cost. It's not your income.
And this really puts it all in perspective. On one side, you have the company's world, the total cost, which includes all sorts of things like long-term benefits you might not see for years. And on the other side, you have your world, your reality, the net pay that actually shows up in your bank account.
So where is all this hidden money? Well, a big chunk is locked away in gratuity, something you can't even touch for 5 years. Then there's the employer's contribution to your Provident Fund, which is great for your retirement for sure, but it doesn't help you pay your rent today. Then you've got the maybe money, like performance bonuses, and other benefits like ESOPs and insurance premiums that aren't cash in hand.
Okay, so enough about the money you don't see. Let's talk about how to get more of it back into your wallet. And for that, you have a secret weapon in your arsenal, the Flexible Benefit Plan, or FBP. This thing is a game changer. Just think of the FBP like a menu of tax-saving options. Your company gives you a certain amount, a budget, and you get to pick and choose from this menu based on your real-life expenses. The goal here is simple, and it's brilliant. Lower the amount of your salary that the government can tax. And what's on this menu, you ask? Oh, just a bunch of stuff you're probably already paying for anyway. We're talking fuel for your commute, your mobile and internet bills, food coupons, even things like professional courses or a driver's salary. These are your everyday costs, and this is your chance to get a tax break on them.
So what does this actually mean in terms of cold, hard cash? How about saving up to 60,000 rupees a year in taxes? Yep, you heard that right, 60,000. That's not small change. That's a vacation, a new gadget, or a serious boost to your savings.
I mean, just look at how fast this all adds up. You've got your phone and internet. That's up to 36 grand a year you can claim, tax-free. Fuel for your car, almost 29,000. Food coupons, another 26,000. Every single bill you submit helps chip away at your taxable income. All right, so that was FBP. Now let's move on to another biggie, a huge one, especially if you're living in a rented place. We're talking about the House Rent Allowance, or HRA. If you play your cards right here, you can unlock some serious tax savings. Now you'd think, hey, I get HRA from my company, I pay my rent, so the whole HRA amount must be tax-free, right? Well, not so fast. The Income Tax Department has a very specific formula to figure out exactly how much of your HRA is exempt from tax.
Okay, so listen closely because this is the most important part. Your tax exemption is the lowest, I'm going to say that again, the lowest of these three amounts. Number one, the actual HRA your company paid you. Number two, 50% of your salary if you're in a metro like Mumbai or Delhi, or 40% if you're not. And number three, the total rent you paid minus 10% of your salary. The smallest of those three numbers, that's your golden ticket, your tax-exempt HRA.
And here's a pro tip, something a lot of people get wrong. When they say salary in this HRA calculation, they don't mean your whole CTC or even your take-home pay. Nope, For HRA, salary is very specific. It's just your basic salary plus your dearness allowance. Getting this right is absolutely crucial. We've covered allowances. We've decoded the jargon. Now for the final boss battle, the big decision you have to make every single year, choosing between the old and the new income tax regimes. This choice, more than anything else, can dramatically change how much tax you pay. So here's the fundamental trade-off, laid out plain and simple. The old regime is all about deductions. You invest, you claim exemptions like HRA, you lower your taxable income, and you save tax. The new regime is all about simplicity. It offers lower tax rates right off the bat, but you have to say goodbye to almost all of those deductions. And look at what's on the chopping block. If you go with the new regime, poof, your HRA exemption is gone. All your ADC investments like PF and ELSS, gone. Medical insurance premiums, gone. Pretty much the only thing that sticks around is the standard deduction, which actually gets a little bump up. So, how in the world do you choose? Well, think of it like this. Are you a super saver? Do you max out your ADC, pay a home loan EMI, have health insurance for your family? You're probably team old regime. But if you prefer a simpler financial life with fewer investments and you just want lower rates without the paperwork, then Team New Regime might be calling your name. Okay, let's put some real numbers to this, because this is where it gets really interesting. Take someone earning 20 lakhs who has a bunch of deductions. Under the old regime, their tax is 3,12,000 rupees. But, wow, look at that. With the new regime, even though their taxable income is higher, their final tax is just 2,08,000. That's a saving of over 1 lakh rupees. This shows you why you can never just guess. You have to do the math for your own situation. So, that was a lot. So, what's your game plan now? It's simple, really. A 3-step action plan. 1. Become an expert on your own payslip. Understand what every single line item means. 2. Squeeze every last drop of value out of your FBP and make sure your HRA claim is on point. And 3, and this is non-negotiable, every single year, run the numbers and calculate your tax under both regimes before you make a choice. Look, at the end of the day, knowledge is power, especially when we're talking about your own hard-earned money. So the only real question left is this. Now that you know how it all works, are you going to let any of your money just get left on the table?